What are some of your views on the way the asset management industry is evolving?
I'm quite worried about the asset management industry and the way it's evolved, particularly in the last few years. I mean, there was an article in The Economist only a couple of months back that said that BlackRock, the largest asset manager in the world, now accounts for something like 15% of total invested capital. And that groupthink, as a consequence of a number of very large asset management companies who are delivering products which are largely, by dint of the size of these organizations, built around indices, is giving investors a pretty rotten deal. I think that such is the power of these organizations in terms of marketing budgets, in terms of their ability to get banks to distribute the product or platforms to distribute the product, to the exclusion of a lot of other very talented and arguably more interesting investment managers, is a real issue.
And what do you hope to see?
At some point there'll be a big backlash to this concentration within the asset management world, and there will be a rejection of these very big names and a big shift into more boutique style asset managers that place a much greater focus on delivering alpha. And I think that is really essential for the salvation of our business. It shouldn't simply be about asset gathering and delivering the minimum acceptable return to keep your client a client. It should be about doing a great job for your investors, whether they be pension funds, whether they be people who've paid in their insurance premiums, or whether they be savers through a mutual fund business.
Is this likely to happen?
Unfortunately, the old adage, "I don't get fired for hiring IBM," is very current in the asset management world. You go to see the private banks in this part of the world, and you find that the names of the managers that they distribute are almost entirely identical. And so there's no real choice from one institution to another. And so some of the shifts in the way that distributors are compensated have played to the advantages of the big asset management organizations, and I think to the detriment of the investor.
What would it take for product gatekeepers to put more faith in less known, more boutique names?
If you look at some of the more successful models in the UK, they have been stockbroking businesses that have effectively evolved into fund platforms. And they may go hand in hand with some form of advice, ratings, rankings, but they hold out a much broader offering than a typical bank platform. So two of the fastest growing businesses in recent years in the UK, for example, have been Hargreaves Lansdown, which is now a FTSE 100 company, and St James's Place, which has recently become one of the top 100 companies in the UK. And arguably they provide their investors with a very attractive choice of more boutique-like managers. And notwithstanding that I'm sure they have some of the bigger names in their offering as well, but largely selected because they have a genuine record of delivering positive returns, rather than simply being measured on the basis of relative returns. One of the big, I think, rather laughable aspects of our industry is that the asset management industry measures itself against its peers. It doesn't measure itself in terms of whether it's really delivered value to clients. It will say, I am a top quartile manager relative to all of the other managers who've done an equally poor job. There are statistics that show, for example, that most investment managers underperform the index around which they're investing. And they don't take arguably sufficient risk that would enable them to outperform the index, or they don't put sufficient work, hard work in terms of resources into targeting significant capital appreciation, which is really what we're all after as investors. So we need to move away from relative measures of performance into a more absolute return culture, which has of course precipitated tremendous growth in the hedge fund industry, but could be equally relevant in the what I would call unconstrained high alpha long only space, which is where I see Milltrust operating.
What potential do you see for household technology names to threaten the traditional distribution model?
A lot of those models will be subject to far tighter regulation going forward. Some of them have had significant success. I mean, if you look at Alibaba in China, they distribute mutual funds, they distribute savings products to Chinese investors, and largely lower risk type of products. But within the wealth management world in China, there have been a number of blow-ups, of course, in recent months, and there is some considerable concern that without the appropriate governance and oversight, there could be unscrupulous people selling products which are simply too high risk to investors, or where the risks aren't appropriately set out for investors to evaluate. The world of investment management is rather paradoxical. You or I, as an investor, can go out and buy tomorrow a highly risky biotech or tech stock or speculative stock which has no earnings on the basis that we think it's a good punt. And there's nothing that anybody can do to stop you investing your money. When it comes to the mutual fund industry, the rules are far stricter, because you're effectively imparting the role, handing over the job of selecting stocks to a third party. And that third party is therefore highly regulated and must set out all of the risks associated with making an investment to you so that you fully understand those. So as soon as you step away from making decisions yourself, where you could lose all your money at the blink of an eye, and put your money into professional hands, the rules kick in. And I see that being a model that isn't going to change. In fact, if anything, it's likely to tighten up. So the new distribution platforms will ultimately be regulated, and that is likely to stifle their growth.
And how will fee models develop in Asia?
Asians have a big problem paying for services in addition to the investment management fee. And the historic model has been that part of the investment management fee would be paid away to people who raise capital or serve in an intermediary function between the investor and the asset manager. I think it'll be a long time before that breaks down. The concerns in Singapore of changing that model towards a more RDR-like framework would have caused a very large number of financial advisors to simply go out of business. And when you have an established way of doing business, as has been the case in most of the Asian countries, you can't change that overnight to a fee-based model, particularly when there is a reluctance on the part of the investor to adopt that model. In the UK, I don't think it's been without pain. There has been quite a lot of consolidation in the financial advisory world. A lot of IFAs have stepped away entirely from the business because they didn't want to take the necessary exams that are required under RDR, and a lot of them have sold their businesses to banks. I think that that's going to be catastrophic, because ultimately this is a highly personalized business. You do business ultimately because you get access to good product and you like the person who is your personal intermediary. You may not have the same relationship with a faceless organization like a large high street bank. So I understand the rationale for fee-based advice, but I think it should be a choice.
Are there any other game changers we're likely to see within asset management?
China is obviously very keen to stake a claim to the international asset management flows that have traditionally gone to big, principally American asset management groups. If you're going to invest into a specific geographic region, I believe that you should be investing with local people, people who have cultural affinity, who live and breathe these economies, and who have potentially an edge over somebody sitting in Chicago, Boston, New York, or London. Now, the asset management business is evolving very fast, but there are literally only a handful of names today in China that run any international capital. And there are only a very small subset of those names that are really capable of addressing the demands in terms of organization, in terms of investment protocols, in terms of ability to communicate with the international investment community, and in terms of having the appropriate structure. And we come back to this issue of safety, of transparency, of providing liquidity and control to investors.
Is there anything else you'd like to add?
Over the course of the next few years, some of the big Chinese asset management groups will become much bigger names on the local asset management scene. And I think that could be real competition for international global investors, global emerging markets funds, or people running Asia ex-Japan mandates here that have had it easy, frankly. And that's probably one of the more significant developments that I would see.